All right, guys, so the accounting cycle is what we are learning. We said that we start with the ledger, we go to the trial balance, and then from the trial balance, we are going to do adjustments. And the adjustments is what we went through. Just to recap, we said that we're going to adjust for depreciation and amortization. We're going to adjust for prepaid expenses, accrued expenses, allowance for bad debt and doubtful debt, right? And then on-end revenue liabilities. We're going to do those adjustments. After we do the adjustments, we're going to have an adjusted TV, adjusted trial balance. And once we get the adjusted trial balance, we're going to use to prepare the financial statements. Okay? So that's number 4. Number 4, we're going to prepare our financial statements. And so for the financial statements, the first one is the P&L account. P&L account, also called a profit and loss account. Another name formally for it is the statement of comprehensive income or the income statements. Does that make sense? Now, it's a movie. The profit and loss account is a movie, it's not a picture. And so we say, for the period, you want to see these words, for the period. And then you put a date. For the period, and then you could say September 30th, 2023, or you could say August 31st, 2023. Always use for the period. That's a CPA question. I don't want you to get it wrong. Because this records from one period, January, through the end of that period. So it's for the period. It is not as of. It's not the balance sheet. It's a movie. Okay? And on the profit and loss account, first thing you're going to start with is your sales revenue. How much sales did you make? This includes both cash and credit sales. It's not just cash sales, okay? So let's say that your sales revenue is 10,000, just for example, okay? And then you are going to subtract all your expenses, less expenses. And your number one expense, if you are a retail or a manufacturing company, is going to be cost of goods sold expense. Cost of goods sold expense. Okay? Cost of goods sold is an expense. We are not interested in how much you sold. We are interested in the cost of what you sold. How much did you buy for the stuff that you just sold? There is a way to calculate cost of goods sold, and I can show you, and it is as follows. To calculate cost of goods sold, you need to say my opening inventory, my beginning inventory. This, you need to know it. You start with your beginning inventory, and let's say that your beginning inventory was 5,000, okay? Plus what you purchases, net of what you returned. So your net purchases, how much stuff did you buy this period, okay? Beginning inventory plus your net purchases. Let's say your net purchases is, let's say, 3,000. So if you add that to this, you're going to get 8,000. We're going to call this the goods available for sale, also called available for sale for simplicity. Some people just use GAS for goods available for sale. And then you subtract your ending inventory. Let's say that your ending inventory is 2,000. Subtract that, and what you get is 6,000. We're going to call it the cost of goods sold expense. So that's how you calculate cost of goods sold. Does that make sense? You need to memorize this. If you don't like memorization, there is a logical way to understand every accounting analysis. And I'll teach you that in the next lecture. This, if you memorize it, it will always help you to calculate the cost of goods sold. But if you don't like memorization and you want to understand it, then the way you're going to do it is you are always going to say it like this. Okay? This is the analysis approach. Cost of goods sold analysis approach. You're always going to start with beginning. Every account in accounting, you can do it this way and you'll be able to figure out what is missing. The beginning is what? 5,000. and then you write the ending. The ending, as we know, is 2,000. And you purchased something. You purchased 3,000. So if I started with 5,000 and I purchased 3,000 and my ending is 2,000, what is missing? This is the thinking or analysis approach. I must have sold how much? Does that make sense? You can do that for every account in accounting. Beginning, leave spaces, do the ending. What did you purchase? What did you sell? And what is missing? In this case, what is missing is the difference between this and that, which is what? 8,000 minus 2,000. That must be 6,000, correct? That is how you don't have to memorize it because you're always going to do it the same way. Beginning, space, 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 ending, purchased, what is missing, and that should be the cost of goods sold. Does that make sense? All right. So that's how you calculate the cost of goods sold. And then you have other expenses like depreciation expense. And then you have SG&A, selling general and administrative expenses, SG&A, selling general and administrative expenses. So let's say your depreciation is 200 and then your selling general and administrative expenses is, let's say, 2,300, okay? Now, if you add all the expenses together, this will be 2,500 plus 6,000 is what? 8,500, correct? 2,500 plus 6,000 will be 8,500, correct? 8,500. Now, if you subtract the 8,500 from your sales, what you are going to get is what we call the profit. Does that make sense? The profit, which is your net profit. So this is our total expense. Total expenses. And then, just for the sake of space, I'm going to come to this side and then say, okay, what is my profit? And I'm going to say, my profit is 10,000 minus 8,500, which is 1,500. 1,500. Now, some people would like to do an intermediate step, which is to calculate what we call the gross profit. The gross profit is the difference between the sales revenue minus your cost of goods sold. And that difference is going to be what? 4,000. Okay? This is the GP, or gross profit. This is SG&A is here. And depreciation expense is here. Okay? Does that make sense? Any questions? All right. Go ahead.